Welcome to the deep dive. We've got a really interesting one for you today, looking at Agnico Eagle Mines, AEM's Q3 results for 2025.
Yeah, it's more than just numbers, isn't it? It's a great look at how a major player handles things when commodity prices, specifically gold, go through the roof.
Exactly. We're digging into their official news release. And the goal here, for you listening, is to get a quick handle on the big picture. Record gold prices leading to record profits, sure, but also how that cash gets put to work strategically and, maybe surprisingly, how it affects costs.
It's quite the dynamic, and you really see it reflected in the CEO Amar Al-Jondi's comments. He highlighted that record-adjusted net income, which came directly from strong operations meeting these expanded margins thanks to, well, sky-high gold prices.
And let's put a number on that price reality check because it really sets the scene. AEM based their internal guidance on gold being around $2,500 an ounce.
But what they actually realized on average in Q3, $3,476 per ounce.
Wow.
Yeah. That difference, nearly $1,000 an ounce, is huge. It's the engine driving everything we're about to talk about.
Okay, so let's dive into those financials. That price difference must have translated into some serious cash.
Oh, absolutely. The reported net income for the quarter was $1,055 million. That's $2.10 per share. Big number.
But you mentioned adjusted net income earlier. That was even higher.
Slightly, yeah. $1,085 million or 2.66 per share. And that's the one analysts often focus on because it strips out any sort of one-off items, giving you a clearer picture of the core operational performance.
Right, the underlying engine's profitability.
Exactly. And hitting a record on that metric tells you just how strong the quarter was operationally, amplified by that gold price.
And the cash flow figures must be pretty impressive, too.
They really are. Cash from operations, before you look at working capital changes, was $1.661 billion.
Billion with a B.
Yes. And that firepower allowed them to generate $1.035 billion in free cash flow. That's the cash left over after they've paid for everything needed to run the mines and keep them going. Real surplus cash.
And did the production keep up? You need the ounces to capture the price.
They did. 866,936 payable ounces of gold in Q3. Meadowbank and LaRonde operations were particularly strong contributors.
So production-wise, things are humming along.
Yep. Year to date, they've produced about 77% of the midpoint of their full-year guidance, so very much on track. Solid and predictable on the production front.
Okay, now here's where it gets maybe a bit counterintuitive for some. The royalty paradox, you called it. High gold prices. Usually you think lower relative costs, bigger margins, but it wasn't quite that simple here.
Not quite. This is the aha moment in the report, I think. A good chunk of their costs are royalties paid out, and crucially, many of these are linked directly to the realized gold price.
So when the price spikes to nearly $3,500.
Exactly. Those royalty payments spike right alongside it. It acts like an automatic cost inflator baked into the system.
So how much impact did that have?
The report states that higher royalties alone increase their total cash costs and their all-in sustaining costs, the AISC, by about $61 per ounce in Q3 compared to what they'd planned for in their guidance.
So even with smooth operations, their AISC in Q3 ended up at $1,373 per ounce.
That's right. And it means their full-year cost guidance, which was $1,250 to $1,300 per ounce AISC, is now likely going to end up towards the higher end of that range.
Making more money than ever, but the cost per ounce creeps up because of those price-linked royalties.
Precisely. It's a good problem to have, obviously, when your selling price is so far above your costs, but it shows how those agreements affect the reported margins.
Definitely a good problem to have.
Yeah.
And that massive cash generation leads us right into the next part. What do you do with over $1 billion in free cash flow in just 3 months?
Well, if you're AEM in Q3 2025, you get aggressive on strengthening the balance sheet. That was clearly a major priority.
How so?
Debt reduction and just piling up cash. Their net cash position, which is simply their cash minus their debt, it basically skyrocketed.
Okay.
It went from $963 million at the end of June to $2.159 billion by the end of September.
Doubled in 3 months.
Pretty much doubled, yeah. It was a $797 million increase in cash on hand, plus they paid down $400 million in long-term debt.
Okay, hold on. Paying down debt, I get it, it's prudent. But with interest rates around, what, 4.5% on that debt and all these big growth projects needing capital, why prioritize paying down relatively low-cost debt instead of maybe accelerating those projects?
That's the strategic thinking, isn't it? By tackling that $400 million in debt now specifically, $50 million of notes at 4.15%, and another $350 million of notes between 4.38% and 4.63%, they're essentially buying future flexibility.
How do you mean?
Think about the commodity cycle. Gold prices won't stay at $3,500 forever, right? By cutting debt now, they reduce their fixed interest payments down the line. If or when the price pulls back, they won't have those interest costs weighing them down. It frees up capital later for sustaining operations or continuing essential projects like Odyssey, even in a tougher price environment.
So it's playing the long game. Financial discipline today meets operational resilience tomorrow, de-risking for the inevitable cycle.
You got it. And the market, or at least the rating agencies, noticed Moody's actually upgraded their long-term rating in August from buy 1 up to A3. That's a solid investment grade bump, and you don't get that without showing real financial prudence.
Makes sense. And of course, with all this cash, they didn't forget about shareholder returns.
No, definitely not. They declared the regular quarterly dividend $0.40 per share.
And they were buying back shares too, weren't they?
Yep. Under their NCIB, that's their normal course issuer bid, they repurchased just over 1 million shares during the quarter, spent about $150 million doing that.
Can you just quickly explain what an NCIB is for anyone not familiar?
Sure. It's basically the Canadian regulatory approval that lets a company buy its own shares back from the open market up to a certain limit over a set period. It's a way to return capital to shareholders by reducing the total number of shares out there. So you see dividends and buybacks working together.
Right. 2 levers for returning value. Okay, let's shift gears from the balance sheet back to the actual mining operations. They're making all this money. Are they putting it to work advancing their big projects?
Absolutely. We already mentioned they're on track for the full-year production guidance, but yeah, the project development pipeline is getting a lot of focus and funding.
The big one is Odyssey, right? At
Yeah.
Canadian Malartic in Quebec, transitioning from that huge open pit to underground.
That's the main event, yes. It's the future powerhouse for them. And things seem to be moving well, even ahead of schedule in some areas. They finished excavating the first loading station back in July, which was earlier than planned.
And the main shaft for the East Gouldy deposit.
Still on track for production starting in the second half of 2026. The shaft sinking itself resumed and had reached 1,348 meters deep by the end of the quarter. So, steady progress there.
What caught my eye, though, was the exploration update from Odyssey. Finding more high-grade gold near the shaft. They're already sinking. That sounds convenient.
Convenient is an understatement. It's potentially a game changer for the mine plan. Hitting intercepts like 4.8 grams per ton gold over 25.4 meters near existing or planned infrastructure is fantastic news. It could mean a second mining front opens up sooner, potentially boosting early production or just giving them much more operational flexibility once things are up and running.
Makes sense. Okay, moving over to Ontario. Detour Lake, they're looking underground there too, beneath the current pit.
Correct. It's earlier stage than Odyssey, still very much in the advanced exploration phase. But the exploration ramp started on July 3rd, and they'd already advanced it 259 meters by quarter end.
And finding anything good.
Yeah, the drilling seems to be confirming the potential for high-grade zones that could support early underground mining. They highlighted one intercept of 2.7 grams per ton over a pretty wide 55.7 meters. It's all about building confidence in the economics for a large-scale underground operation there eventually.
And way up north, Hope Bay in Nunavut. Logistics must be everything there.
Totally. Access is key in the Arctic. So completing the jetty expansion in time for the 2025 sea lift was a critical step for getting supplies in efficiently.
And they had a bit of a cleanup bonus.
Yeah, kind of. While they were dismantling the old mill equipment, they actually recovered about 2,442 ounces of gold that had been sort of trapped in the circuits. Sold that in Q3, a nice little unexpected bit of cash.
Every ounce counts. But more strategically, they're looking deep there too.
Yes, the exploration focus is on confirming the potential at depth. They hit 16.9 grams per ton over 4.6 meters way down at 866 meters in the Patch 7 zone. That kind of result helps build the case for Hope Bay being a really long-life asset, proving the mineralization continues deep underground.
Okay, so lots happening on the gold front.
Yeah.
But the report also flagged a pretty significant strategic shift, didn't it? Looking beyond gold and copper.
It did. This is potentially quite a big deal for their long-term strategy. They've officially approved setting up a whole new subsidiary called Avenir Minerals Limited.
Avenir Minerals.
Yeah.
And its focus.
Solely on critical minerals. So, things other than gold and copper. Initially, the focus will be on opportunities within Canada.
Why spin it out into a separate company? Why not just have an internal division handle it?
It's a pretty common approach, actually. Setting up Avenir does a couple of things. It keeps the management focus clear. AEM stays laser focused on gold, while Avenir tackles the different challenges and opportunities in critical minerals, which have, different markets, different risks, different investor bases sometimes.
Right, avoids diluting the core gold focus.
Exactly. And it also creates options down the road. Maybe Avenir seeks specialized partners or different funding structures that wouldn't quite fit under the main AEM umbrella.
And they're giving it real resources to start.
Oh yeah, it's not just an idea on paper. They're seeding Avenir with an existing portfolio of strategic investments they already held, valued around $80 million, plus injecting $50 million in cash. So it's hitting the ground running with significant backing. It's about creating future options in that whole energy transition material space.
Interesting move. Okay, wrapping up the quarter's news, they also touched on sustainability and community work.
Yes, they highlighted a few things. Their podcast series, Arctic Edge, actually won some awards, which is nice recognition for their communication efforts, particularly up north.
Good for them. And safety awards, too.
Yeah, the La India mine in Mexico got a Silver Helmet Award for safety in the open pit category from the Mexican Chamber of Mining. Always good to see safety recognized.
And something about local training.
Right, the Mikasa Mining School launched in September. That's focused on training people locally for underground mining jobs, building that skilled workforce from the community. They noted the first group had 38% participation from First Nations members, which is a really positive sign of local partnership and employment focus.
Okay, so let's try and pull this all together for you, the listener. What AEM's Q3 shows us is really a two-pronged story running in parallel.
Exactly. On one hand, you have this incredible financial performance driven by that 3,476 aircraft realized gold price, leading to record adjusted profits. And what did they do with it? Immediately strengthened the foundation, doubled the net cash, paid down debt aggressively, secured a credit rating upgrade. That's textbook financial discipline in a boom.
But on the other hand, they weren't just banking the cash. They were simultaneously pushing hard on the future, funding those huge long-term growth projects like Odyssey and Detour, proving up resources at Hope Bay, and making that strategic leap into critical minerals with Avenir.
It really is a blueprint for how you allocate capital when times are good in this industry. You lock down your balance sheet to weather future storms, but you absolutely keep investing in the assets and strategies that will create value over the long haul.
Now, before we finish, there was one little flag raised, almost a footnote in the report, regarding potential headwinds, tariffs, and trade disputes.
Ah, yes, the macro environment risk. They did mention the sort of ongoing uncertainty in global trade, particularly U.S.-Canada relations. They made a point of saying their revenue isn't likely much affected as the gold gets refined elsewhere.
And they estimated about 60% of their costs are things like labor, energy, royalties, stuff not directly hit by tariffs on goods.
Right. But, and this is the crucial part, they explicitly stated that the cost guidance they provided, that range expected to finish near the top end, does not factor in any potential impact from future tariffs or trade actions.
So there's no unquantified risk there.
Exactly. It leaves you with something to think about. They've managed the known variables incredibly well this quarter, fortifying the company financially. But how might that remaining 40% of their cost structure, the part potentially exposed to supply chain disruptions or new tariffs, be impacted if global trade tensions flare up? That unknown factor is probably the next big external challenge they'll need to navigate.